S&P 500 has just broken another all-time high. As of making this video, it is up by 26% year to date and is already outperforming the previous years, which only saw a 24% return. Understandably, this caused many investors to have a mixed bag of emotions. On one hand, everyone is celebrating because they have gotten phenomenal returns. On the other hand, they know that this isn't normal because the S&P 500 is only supposed to be giving 10% average returns in a normal year. But now they are giving huge returns year after year after year. Like in 2019, it gave 29%, then 16%, then 27%. 2022 was the only year we saw negative returns. But the market quickly recovered and continued to give 20% returns. Like, where's the crash? Shouldn't it be crashing like right now? Why does it keep going up? Is this even sustainable? In this video, I'll be addressing all this. Is the market truly irrational? Or is there a real reason behind this rally? Where will the market go over the next few years? Then finally, I will share what's the best investing strategy going forward. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you might have. So in the short term, we all know that the latest rally was caused by Trump winning the general election. That's because his economic policies are good for both the market and the economy. First, he plans to cut taxes in multiple areas. This will help to boost personal savings rates and corporate profits, which means faster economic growth in the coming few years. Then, he plans to deregulate certain stuff, so you will see more mergers and acquisitions going forward, more oil and gas production, less stringent requirements in the pharmaceutical and biotech sector, while companies like Tesla will have less regulatory hurdles to overcome, and there will be a shift in antitrust laws. Not just that, given that the Republicans also took the Senate majority, the US now has a strong united government that is able to get things done a lot faster. Add in the fact that this is Trump's second term in office, he's a lot better prepared now. Now, of course, it's not all just good news because Trump's tariff policies are expected to be inflationary, with Bloomberg Economics expecting it to raise inflation by 2.5% and GDP to decline by 0.5% over the following 2 years. Though, overall, Trump's economic policies will still be a net benefit for both the economy and the stock market, which is why the S&P 500 has been rallying so hard after his victory. But then, given that the market has gone up so much over these past few years, surely it has to be overvalued, right? Well, yes. Check this out. If you look at the cyclical adjusted price to earnings ratio or the S&P 500 Euler CAPE ratio, it is now at 38, far above the average and is now near the 2020 levels right before it crashed. However, you also need to remember that this Euler CAPE ratio is backward looking, as it only looks at the past 10 years earnings and does not factor in any future returns. Instead, a better metric to use would be the S&P 500 forward PE ratio, which takes into account projected future earnings. And you can see that it's still a little overvalued, but now it looks a little better as it's still below 2000 and 2020 levels. So is this value justified? According to the US bull, Tom Lee, yes, that's because 1. The war on inflation is now largely over, and inflation is steadily trending downwards. 2. The Fed is now starting to lower interest rates, which will make borrowing cheaper. And 3. There's no recession for the foreseeable future, as the US economy remains relatively strong and the unemployment rate remains stable. And 4. Even though the markets have been going up, the margin debt level hasn't been really rising, which means we still aren't at the crazy market speculation level yet. 5th, we have multiple tailwinds, such as growth in AI technology, which can further boost profits, and Trump economic policies, which as mentioned earlier, are pro-growth. 6th, as of right now, there's no evidence of a credit crisis emerging. Not just that, even though the S&P 500 has been giving fantastic returns over these past 2 years, a large part of these returns came from just the top 7 stocks in the S&P 500. Interested in getting 1 free Apple share and 1 free iPhone 16 Pro Max? Check out Longbridge, the latest brokerage in town. Terms and conditions apply, of course. Longbridge offers low commission trading for stocks from Singapore, Hong Kong and US markets, with fees starting from as low as 99 cents per order, plus lifetime commission-free trades for both US stocks and Hong Kong stocks. For full details, visit Longbridge pricing website. Longbridge has a user-friendly interface, free real-time data, company research tools, latest news, and advanced charting tools. Or if you are looking for quick and comprehensive answers, you can check out Longbridge Pod AI, the industry's first financial GPT to help you with various financial queries. But remember, this is for informational purposes only, yeah? New users who use my exclusive link to sign up and fulfill all the requirements will receive up to 1 free Apple share plus an extra $18 cash reward. Plus, if you can perform a shares transfer in of at least 10,000 SGD and fulfill the respective criteria, you will receive anywhere from 100 SGD stock cash coupon all the way to 1 free iPhone 16 Pro Max 256GB. Terms and conditions apply. However, what's changed recently is that the rest of the S&P 500 have been starting to play catch up. That's because the Fed is now starting to lower interest rates, which benefits the smaller companies that are more reliant on debts to grow their businesses. As a result, you can see that in recent months, their earnings growth has been improving, while the equal-weighted S&P 500 ETF has been outperforming the market cap-weighted S&P 500. Not just that, small cap stocks, which have largely underperformed large cap stocks in recent years, are also starting to make a comeback. And because of all these reasons, Tom Lee believes that the S&P 500 could hit 6,700 level sometime in 2025, which represents another 10% increase from current levels. However, with that being said, I would still caution against being too bullish about the S&P 500. Because while everything looks good now, investor sentiment can easily change in a blink of an eye. Here's why. 1. Warren Buffett has been a net seller since October 2022. You can see that he has been slowly trimming down his positions and is now sitting on a record $300 billion cash position. However, this is not to say that he believes that there will be a crash soon. In fact, he himself said that he doesn't attempt to forecast the market. Instead, he focuses on finding undervalued stocks. The real reason as to why he has been trimming his position is because he believes capital gains tax are now currently low and it might go up in the future. So he just wants to take profit to save on costs while he can. But the other reason is that he feels that his stocks are trading near or above their intrinsic value. And this is important to remember because historical data has shown that if you were to invest when stocks are so richly valued, you can expect future returns to be low. This is also the reason why many analysts are now forecasting the S&P 500 will give lower returns over the next few years. 2. Even though the US economy is stable now, it is certainly slowing down. Plus, the job market is also getting weaker and weaker. Though, it's worth noting that the recent weak jobs reports was due to strikes and hurricanes. Not just that, Trump, with the help of his new friend Elon Musk, is also planning to cut $2 trillion from the federal budget, possibly from places like transportation, education, housing, and environmental programs. This could cause an initial severe overreaction in the economy, and Americans will have to brace for economic hardship over the short term. Will this happen? Maybe, maybe not. There's no point anticipating this because no one knows what will happen in the future. But speaking of uncertainties, there are a lot of uncertainties going on around the world. For example, there's growing tensions in the Middle East, which could affect oil prices. There's the Russian-Ukraine war, which could affect commodity prices, and Trump is about to affect this war real soon. Meanwhile, the US has ordered TSMC to halt shipments to China, which could further raise tensions between US and China. And with Trump being president again, we can expect a lot more stuff to happen, all of which can impact the economy and the stock market. Which brings us to the question, how should you be investing now? Should you be investing more now, given that we have multiple tailwinds that can boost the S&P 500 to another all-time highs? Or should you be cutting back on investing in the US market now, given that it is overvalued and there is so much uncertainties? Or maybe we should look to invest into other undervalued places like Singapore REITs or even China, which haven't been doing as well? I can't tell you what you can do with your money, but I feel that if you want to, it's certainly okay to diversify your portfolio, especially if you see value in good undervalued companies. For example, after REIT's recent drop, it is starting to look attractive again. Or with China's recent stimulus plans, probably the stock market might finally recover. But personally, my plan is to just stick to the US market, as that's what I'm more familiar with. And also because I have faith that the US markets will do well, not over the short term, but over the long term. That's because over the short term, the market can be affected by a whole lot of things, such as earnings growth, interest rates, inflation, market sentiment, monetary policy, and so on. But over the long term, the thing that I'm betting on is the growth in earnings per share. In the short run, the market is a voting machine, but in the long run, it is a weighing machine, which means if you are a long-term investor, the only thing you need to care about is, are my companies becoming more and more profitable? If you know how to read financial statements or analyze companies, great, you have a better chance of picking good companies and outperforming the stock market. Otherwise, if you don't want to do all that hard work, just go with ETFs, like the S&P 500 Index Fund if you are bullish in the US, or an all-world index fund if you want to diversify globally. Forget about market timing because it's absolutely impossible to time the market unless you are hardcore. Will a crash come? Absolutely. In fact, we will see a 5% drop every year, 10% drop every 1.5 years, 15% drop every 2.5 years, and 20% drop every 4 years. But as counterintuitive as it may seem, even though I know a crash will come, it's still better to invest now because 1, we don't know when the crash will come. Maybe it will come tomorrow, or maybe it will come 10 years later. And 2, crashes tend to be short, while bull markets tend to be stronger and longer. So rather than trying to time the market by not investing now, a better strategy is to just dollar cost average as per normal, while setting aside some war chest money in case a crash did come. That way, you get to participate in the upside, while at the same time, time the market by taking advantage of any crashes. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.